He's rubbing us out.
Anytime you're ready, Mark.
Oh, I thought you're waiting. You were going to start.
I will start. Okay, so I'm going to count to 3, and then you can press the record. Okay.
We're recording. Go ahead.
Well, good evening, everybody, and welcome to the first session of the Mid-Michigan Manifest Investing Campfire. My name is Ken Kavula, and I'm a director with the Mid-Michigan chapter, as is my good buddy, Mark Robertson. Together, we're joined by a director from the Maryland chapter, Kevin Galogli, and a director from the San Francisco chapter, I think, Craig Bramer. Craig, did I get your chapter correct?
That is correct.
Absolutely. Thank you so much. Craig is coming to us from the West Coast, so he's ensconced at 3 o'clock in the afternoon rather than 6 o'clock in the afternoon. But we're going to be talking tonight about a book that dates from back in the 50s. It was the first book ever reviewed by Better Investing magazine way back in that time frame. And it was written by a set of brothers, David Babson and Thomas Babson. And I'm not going to tell you very much more than that because we have a bunch of slides to cover some of the things. Again, if you have questions or concerns or just comments that you'd like to make throughout the discussion, and this will be a pretty free-form discussion with all 4 of us participating, send me a hand raise and I'll unmute you and you can speak to us. Or if you don't want to talk on mic, then send me a question in the questions box and we'll try to get that question answered or that concern addressed. So without further ado, I'm going to turn it over to my good buddy, Mark Robertson. And Mark, it's all yours. Take it away.
All right. Well, thanks. Thanks, guys. Welcome, and welcome to our audience for joining us this evening. I think this is kind of a cool subject. Kevin Galogli basically came up with this, and he'll be kind of your semi-moderator, kind of like, the guys who do the Emmys and the Oscars. He'll come up with make sure that we stay on time and everything. But this
how much is Kevin given to the Boys and Girls Clubs, and what will we lose if we go over the time, Kevin?
I don't know, Kevin.
You get bonus points.
Bonus points. Okay.
Well, it could be Portillo's gift certificates. No, what I basically want to kind of pay a little bit of tribute to is I was a member of the Mutual Investment Club of Detroit, and the legends have it that they would go on canoeing and camping expeditions. That was before my time, but I think this could be kind of a tribute to that. We want to keep this fairly wide open and flowing, but just kind of share some observations about the foundations of the modern investment club, and I'm going to call it a phenomenon. The more we learn about it, the more we actually delve into it. It really should be recognized as more of a phenomenon, and that's kind of what we're here to do. So thank you, Craig, for joining us, and again, Kevin, and let me go ahead and get us underway here. This is just kind of the genesis of the idea. Kevin wanted to talk about this book as the launch pad for exploring the origins of growth investing. And one of the authors of the book, David L. Babson, was quite an influence, as we'll talk about here, with George Nicholson and the Modern Investment Club Association. And again, the book was reviewed in Better Investing magazine back in 1960. So we just encourage everybody to be aware of it. And again, we'll be looking for the lessons that we can learn. Kevin, would you want to introduce Mr. Babson?
Sure. Yeah, and as your previous slide said, this was the first book ever reviewed in the BI magazine. And so Babson gets out of Harvard in 32 with a history degree, and he goes to work for, it's either his first cousin or uncle, Roger Babson, who had a Babson Reports. He did statistical analysis, was very similar to Standard Statistical Service, which eventually became part of Standard & Poor's. But he decided to, but his magazine, the Babson Reports, is really the precursor. If you see the CFRA, their weekly magazine, The Outlook, and they claim it goes back to like the mid 1920s, it's really the Babson Reports that sort of starts it. So he starts his own company in 1940, and it's not his brother, it's actually his first cousin is Thomas Babson. And he joined him after 20 years at General Electric. He spent about 20 years with Babson before he decided he really wanted to do what he enjoyed best, which was genealogy. But I always think understanding a little bit about a person's background and where they come from, it's going to color anyone's experiences. So he comes out of this sort of statistical, analytical look on how to be able to do things and all the stuff that's going on. So I think if you understand that, then it starts to make a little bit of sense. We can go on to the next slide,
Okay.
unless there's something you want to say about Danko.
I just want to draw attention to that word at the very bottom of the slide, because it's going to be reappearing in our discussion, and it reappears in almost every better investing discussion that I'm involved with, and that's the word reasonable. And I think Babson is probably the person that puts that word into our vocabulary and makes it something we can kind of count on as we go forward in our analysis.
Yeah, and I know you're a great fan of industry studies, so there you go. By the way, I think that picture was actually in the Better Investing office, and as near as I can tell, it's the only known picture of David Babson. So there you have it. It's been used a number of times. I think it's probably appeared 100 times on the pages of Better Investing. I just wanted to share a moment. I never met David Babson, but I did meet his protege, Brad Perry, many times. I worked directly with Brad. Brad wrote the book Winning the Investment Marathon. It's an easy read. It's a good read. You do not have to be an advanced investor to get the gist of what he's talking about. I will tell you, I'm not a big reader, and I read it in one sitting. And he singles out Babson, again, his mentor, as one of the greatest investors. I like the main quote. I've heard that before, but again, you could substitute the word reasonable for sensible into that quote. And so, as Kevin was hoping, I do believe that if we keep doing this on a regular basis, we will explore some of the works of the names that you see on this page. I had not heard of Claude Rosenberg until tonight, and we'll be digging in and seeing what Claude was all about. But we obviously know the other names. The other names are very familiar. John Neff of the Windsor Fund, of course, Templeton, and the names are very familiar. But again, coming down to the last word on the slide, their real gift to us was the demonstration of discipline. Any other thoughts on here, Ken?
No, let's just keep going, Mark.
Okay. Go ahead and set the stage, guys.
So here's the thing that's going on. When everything sort of starts in like the 20s or so, everyone is saying, no, we really need to, you want to be able to always have income coming in, and therefore bonds are better than stocks. And here's just some general stuff I pulled out in terms of what the bond yields were at different times. You can see back in the 20s, they were somewhere in the 5 to 6% range. Right after the war, it was around 2%. When interest rates were really high, bond yields were up around 15%. I don't even know what they are right now. But if you look at that, and if you see the stock dividends were at the same point giving a very high dividend yield. And a lot of the reason is because they had to be competitive with the income that you could get from a bond. So that's the reason why they were pretty close to each other. And as you can see, they steadily have gone down as things have gone on. Before we go to the next slide, anything you guys want to add about these yields?
Well, I just want to add that if we're looking at stock dividend yields today, we're looking at an average dividend yield under 2%. So you can notice that the environment for investing was quite different when Babson was very active in the stock market in the 40s and beyond. And today's a different animal, a different blend of where you can get your appreciation from in the total price of a stock.
I wonder if Craig might have a few words on.
Yeah, I was just going to add bond yields today are probably closer to 4, depending on the type of bonds. But also, if you go back and talk to prior generations, there were many generations scarred from the 1930s Great Depression, and they just avoided stocks. They just said they don't want to be there because they don't want to take risks. Now, what we've learned since then, and particularly in the last 50, 70, 100 years of data, shows that stocks generate a better return performance-wise over long periods of time. But for many people, including both my grandparents, stocks were, something you didn't really do. So it's just a change in mentality over long periods of time.
Well, we also have enough data to show that a longer holding period, and that was something that wasn't available. The data wasn't available in the 20s and 30s and 40s, but today the data is available that show that a longer holding period for stocks takes that risk that was so evident after the Great Depression or during the Great Depression, takes that risk and kind of takes it down near zero somewhere for very long holding periods. And that's something that we want to drive home with our newer members and the people that are just beginning to invest, that our philosophy of long-term investing is something that doesn't have an inordinate amount of risk attached to it.
100% correct. And a lot of presentations I do out here in San Francisco, we will show 20-year charts, 10-year charts of rolling returns going back for decades, and rarely do you see a decade where the market does worse than the bond side. And so it just shows to people that you make money in stocks over the long run, historically. And if you have a long enough time horizon and you can stick with it, you will be rewarded generally more often than not. So,
I think the last thing I would add is, if you think back to the original days of the stock selection guide and the work of George Nicholson and the founders, back in that time frame, you can see it right on your screen on the lower left, the dividend yield of a stock was a major part of the total return. So it was a bigger component of the analysis on the stock selection. It's still a component, but it has shifted around. And I think when you read something written in the last 10 to 20 years, you have to basically put it through the filter of, what's an average dividend yield, like Ken was saying, under 2%. As you get the appropriate context. So let's go ahead and go press on here. So here's kind of the question for tonight. Things have changed. Those dividends have changed. How would Babson, again, look at things in the 1990s versus the 1940s? And here's the answer to the question. So, Kevin, what are your thoughts?
Well, I mean, when I saw this passage and I sent it over to you, is that it sounds exactly like what we would do on the ISSC. You want companies with solid earnings credentials, long track records, and that you want to avoid the conventional thinking that goes on that lures us into all these different crazy directions. That is the nature of what we do, whether we're using Manifest or the SSG or anything we use to do fundamental analysis on a company. All of those things are based on those points.
Kevin, when I read this quote on the slide tonight, and when I first read it in the book, I was a little bit concerned about it, that he began his track record or his study with earnings. And I really feel that it's important for us to understand that you can't have earnings unless you have sales. And I think that sales growth underpins everything that Babson is talking about, and it underpins everything that we do in a stock analysis. That whole concept of things flowing from sales is a very important one to keep at the top of your mind.
No, it is. And if you look at, I'm pulling out my book right now. We talked about this when we did a prep session, is that I'm looking in chapter 11, page 132 and 33. This is where, again, he talked about income, growth stocks, and then cyclicals. But he talks about here are sort of the things that you should be looking for. And he does start with sales. You want to have sales that are growing faster than the economy. And then he does talk about profit margins and net margins, so earnings per share, strong management, all of the things that we talk about, he did. And so in this particular case, he is mentioning earnings. And this quote actually comes from a book called Five Eminent Contrarians, Stephen Mintz. I think there'll be a reference to it later. But the point is that in both cases, he's really saying the same thing. It's almost as if he was telling us what to do on an SSG as a beginner.
That's what I
agreed 100%, Kevin.
Yeah, very much so. There's so many things here that in this and some of the speeches he did over the years that he just touches on a lot of the same things we talk about with our SSG. And you can even see in here, third sentence down, consistently high profit margins. That's something we would like to look for a lot of our companies, because we know that's tied to potentially good, solid profitability over long periods of time. So all the readings I got out of this was that I was almost reading a tutorial on how to do the stock selection guide at the end of the day.
Yeah, and I think you'll see we'll reinforce that with some of the summaries as we go through with it. It sounds like he's almost going through a step-by-step dissertation on the stock analysis method that we use.
And I'm just going to share something from a 1971 speech that he did, and a couple comments that he made that I think reverts or is shared heavily in our world. Number one, that his concern at the time there that this new investment style called high turnover or secret sauce investing was a interesting, but is that really going to work? And then secondarily, focusing on companies that don't have earnings. That was starting to be a trend back in '71, and so things that we talk about pretty consistently in our world of trying to find companies that have been around for a while, that have been able to generate good sales, good earnings, and hopefully good profit margins are pretty good consistency things to find in companies if you're looking to make money.
Yeah, I can remember the article he wrote in the mid-1960s, I believe, about the go-go stock market, and he was complaining about mutual funds that had reached turnover ratios of 40%, as if that was something exorbitant. And well, that would be a minimum turnover ratio for most of the funds out there within the last several years. So very interesting. Good stuff. All right. So here's the book that Kevin is teasing us with. Go ahead and tell us how'd you find this, and what are your?
I found it about the same time I got the Babson book itself. Is that I was trying to find as much information I could about Babson, and I was told he was. I think Mark, you maybe even told me that he was sort of one of those growth investors, right up there with Phil Fisher and T. Rowe Price, but yet he wasn't really recognized with that. And you turned me on to Brad Perry's book, Winning the Investment Marathon, and then I found this book. I got it probably 15 years or so ago. Same with the this book on contrarians that he was mentioned in it. I said, okay, let me take a look at it. And he like I said, he started his own company in 1940, and right after the war, everyone's talking about how the sky's falling, we need to go to bonds. And he goes, no, that isn't it. He goes, as this quote, this went to his clients he was talking about what was coming up in the coming year. I think you could substitute, 2026 to this. It's not whether we're going to have a recession next year or the year after that. You have to wonder, is this a twilight of the U.S. capitalism, or do you think we're on the threshold of the greatest period of prosperity in our history? Well, you may disagree with the greatest period of prosperity, but you could just say, do you think we're going to have prosperity in our future? And if the answer is yes, then stocks is a way to go. And I mean, this article was mentioning that the Wall Street Journal at the time and one of the big columnists in the Boston Globe at the time were like, no, 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 be in bonds, be in income. You can't trust stocks. They're too, risky.
Yeah, and I think this is an important point to make for the audience. If you think back to the time frame, he starts his business in 1940. Nicholson was just finishing school. The 1940s was not that long after the Great Depression. As you guys have already said, I've heard my grandparents talk about, the casino nature of the stock market, and so many people were burned back then that, they are basically, Babson and this group of people that we're talking about were speaking heresy when they're talking about, yeah, you can buy a growth company, in Abbott Labs and hang on to it for an extended period. And so they had some convincing to do. Treated very skeptically.
You guys make me feel really old. You're talking about your grandparents. I can remember my parents talking like this. We were both children of the Great Depression, and I'm thinking to myself that we just went through a cycle like this within the last year and a half. How many remember that in 2023 and early 2024? We were predicting that we were going to have one of the greatest recessions by the end of 2024, maybe 2025 early on, that we had ever seen. And all the talking heads on TV were talking about it at that time. Knocking on wood isn't going to negate the fact that we will see another recession, but I don't think predicting it is something that anybody is able to do with any certainty.
Very true. All right.
Very true.
All right.
Would agree.
So this is cool. I mean, you think about what they were up against. Check this out. Go ahead, Kevin.
So when I was doing work on this, the book, The Five Eminent Contrarians, mentioned Edgar Lawrence Smith. And I sort of looked him up. I had heard maybe the name. He could maybe be considered the first growth investor. And he did it by accident. He wrote this book, Common Stocks as a Long-Term Investment. And he originally did it as a pamphlet to get people to buy bonds. He was, I guess, a bond salesman. And his research, going back to the 1870s, came to the opposite conclusion. And that last bullet, that quote is the start of his book. It's the first page, first line of his book. These studies are a record of failure. The failure of facts is to sustain a preconceived theory. Is that he found that if you had dividend yields from stocks at 4% and bonds at 4%, you would be better to own stocks because of the fact of what he called retained earnings. We still call it that today. And he was the first one to sort of recognize retained earnings and how that can allow a company to grow. And that was sort of maybe the first shot across the bow that bonds weren't necessarily all they were supposed to be. And this, at the same time, you have this sort of mania in the late 1920s. Again, stock market wasn't regulated like it is now, as it is now. And there's a whole host of other things that we've done regulatory to avoid these things, to be able to sort of smooth things out. And so all of a sudden, these people go on in with margins, which you could buy common stocks regularly that way. In fact, most people did. That all of a sudden, you get to the 1940s and people think, no, we don't want to be in bonds because it's only 15 years earlier that we had this mania collapse in our face. So you're already burned once. You're not going to do it a second time. And that's basically when Ken and I first talked about this book, he sort of felt it was a little outdated. But I think if you understand the audience that Babson was writing for, is that he was looking at people that had probably had firsthand experience with what happened with the market in the 1920s, and therefore didn't think that this was reasonable. So Babson ends up spending really the first half of the book outlining why, giving you cogent examples of why what happened in the 20s isn't going to happen now. And now he's saying, look, we cannot look at just common stocks, and Babson does this, he looks at both income stocks and growth stocks. He also does cyclical, but he basically does an example of between the two. And he says, yeah, you can do okay with these income stocks, but guess what? You can do even better with growth stocks.
Yeah.
Anything you guys want to add on this?
I'd like to add real quick on just the mentality that comes out of these major events coming out of the 30s. I wasn't around, but I definitely heard stories from my grandparents. But you can talk to people that came out of the 74, 75 market debacle, and you know, the impact on them as to why they didn't want to get into stocks. And you know, same thing would happened after 2008. You would talk to people and they would go, I don't want to own stocks. Stocks are dangerous.
Mm-hmm.
And it took almost a decade for people to kind of get back, most people to kind of get willing to get back into the stock market again. And I then found later in that decade, when interest rates were incredibly low, that it made, you know, I could get the same yield on an S&P 500 index as I could on a bond. And it made no sense to ever want to own a bond in that kind of environment where I could still get potential growth in the stock market over long periods of time.
Yeah, I'm going to make a note to self. I want to figure out what Edgar did with this information and see what his track record might have been.
Yeah, that going back in history is sort of like talking to those of us that bought our first house with an interest rate of almost 18%.
Yes.
They were that high in the 30s, Ken?
Yeah. And then you got running water.
You got a flush toilet? Oh my God.
All right. I thought Craig might want to give us a little bit of insight into what changed and, you know, some of the history of regulation, if you can encapsulate it here.
Sure. Well, we had a number coming out of the 30s and the Great Depression. There was a lot of regulation that was put into place after a lot of unregulated security activity, and that had direct impact on the economy. Some of the biggest things that we all are probably familiar with today would be the various different acts by the SEC, creation of the SEC, and the ability to monitor what people are doing in the stock market and some regulatory event. There's also safety nets put in place from the government to help support people so that if they were to lose their house, their job, they had something maybe to help them keep them going in the long run. And then eventually, you know, World War II came around, and then that eventually helped pick up the economy again, partly because we had a lot of people going to fight in the war, but also we were producing lots of goods, not only for us, but for the rest of the world to fight in the war. And that really helped our economy come back. So,
anything you'd like to add to that, Ken?
No, not immediately, except to say that all of the things that lead up to the 50s point to something that people were entirely unused to seeing, and that was some kind of prosperity. I mean, I talked to my parents, and I realized that they lived through a very unique time in history of basically, let's say 15 years from 1939 through 1929 through maybe 1945. They lived through a period when there were no goods available, and if there were goods available, you didn't have the money to buy them. And we haven't seen that recently. We get disturbed now when we have a downturn that lasts 6 months or 8 months or 10 months. Even 2008 is called the Great Recession, although I don't think it does anything to compare to the depression that occurred after the 1929 stock market crash.
Yep. All right, pressing on. Just a little more perspective on Babson.
Why don't you take this one, Mark?
I don't like it. Craig probably doesn't like it either. It's kind of interesting though, because he was very animated and critical of his own industry throughout his career. Anytime that people were doing unreasonable things, how's that, Ken? Unreasonable things, and again, here he's just basically taking a shot at some of the newsletters and publications that are out there, and that newsletter is not going to take care of you by itself. And then, of course, the Brad Perry brings up a fairly chuckle-worthy quote down there at the bottom. Although I will say that subscribing to the Journal of the American Medical Association would be better than doing nothing.
It might even be better than going on the internet and trying to diagnose yourself today, Mark. Wasn't Babson basically just saying at this particular point, if all the things that you're talking about are true, prove it. That's basically what he's saying in a nutshell.
True. Yep.
I think there's that. Plus, today you read about how many different people get their investment advice from all over the place, whether it's podcasts or other things in this world. And trust me, having been in the investment world for 40 some odd years, if you're really great at picking stocks every time you pick the stock based on your write-up that you send out to people, you'd be a billionaire and you'd have no reason to be doing this anymore. Similar to what he suggests. And so it's just ludicrous to me when I keep reading all these different things that I'm the one person that can tell you when to get in and get out of the market, and I can tell you which stock is the best one to buy. I've been doing this way too long to just be too cynical and say, that's not true. That's not right.
And those of you in the audience that have been with us on all of our travels through probability and many of our bull sessions understand that we're great proponents of the 55% rule. Mark, why don't you tell them what the 55% rule basically is?
Well, it's basically a mathematical proof put out by Joel Tillinghast. He ran the low price Fidelity Fund, and he was actually a protege of Peter Lynch and a member of his team. And it basically just says you only have to be right 55% of the time to have a handsome total return result. And so in other words, you can be right 11 times, wrong 9 times, and you can still be okay. We talk about that a lot at Roundtable and the bull sessions. So keeps us grounded. All right, so pressing on, this is just a quick summary of what Babson thought was important. I don't know how much time we need to really go over these, but you guys talked enough. When we first started talking about this, you were kind of drawn to the fact of reinvesting, or the concept of reinvesting in your own enterprise and stuff like that. What are your thoughts?
I think the one thing on the list, Mark, that I think that our own members in Better Investing tend to kind of minimize, maybe to their own detriment, is that last one on the list. Nicholson was so clear in his writings. When you read pamphlets and you read transcripts of speeches that he made, that he kept trumpeting 3 words: buy the best, buy the best, buy the best. And I think a lot of times we focus on individual stocks rather than on individual stocks as a single entity within a peer group, and then looking at the peer group to find out if there's not maybe one even better than the one that led us to the idea in the first place. I think that's the only thing that we don't do enough of on this list as Better Investing members. I think all the rest of the stuff, we're kind of focusing on a lot of these things as we do a complete, thorough, reasonable analysis on the stock selection guide.
I do think he's talking about growth or sales growth up here, Ken.
Oh, I'm sure he is at this particular time. Yeah.
That right there is section 2A.
Yep.
On a stock selection guide.
And the first one, to me, is a highly important, focusing on sectors that are outpacing the economic growth. Well, it explains totally why investors and the S&P 500 has such a large weight in technology. Why? That is one of the faster growing segments of our country, and it is growing faster than the overall economy as a whole, and probably will for many, many more years to come. Doesn't mean every one of those stocks are going to work, but many of those, that's a good sector to be at least looking in to try to find things at a reasonable price.
It also gives us a good reason for ignoring certain sectors. Not ignoring is a bad word. For minimizing certain sectors where there is no real growth that outpaces the overall economic status of the country or situation in the country. I find that A lot of folks still are telling me that I should be looking at utilities. Well, maybe artificial intelligence is going to usher in a time when some utilities are outpacing the overall economic growth of the country. But for the most part, utilities are something that kind of grows at the same rate as population growth grows. And that's not enough growth for me as far as looking at stocks. If I'm only going to hold, a couple, maybe 15 stocks, I don't want a utility.
But Ken, that also
And one of the things,
I was just going to say, Ken, that kicks the door open to something that he did demonstrate with, we'll see, Dow Corning and companies like that. When we go after a company like Powell Industries, you're going after them all the utilities and all the projects and all that stuff. And you're trying to find a leader that serves that particular niche. And yeah, I agree.
I want to hit on that
rather than digging a mine, right, Mark?
Mm-hmm.
I want to focus on that third bullet point, because he has a whole part of one of his early points where he talks about research management teams. He goes, you really want to have these research people, that there's sort of this new growth in terms of people going to college that are trained in analytical approach, either in business schools or what have you. And he talks about how much more private research has grown over the 30 years from the 20s to the 50s, and how looking for companies that have a high research budget, they're going to be able to be at the cutting edge. And that's what we were talking about last night, where Craig was like, yeah, those are the patents and what have you. And you're going to see that they're going to have moats over those stuff. And he doesn't talk about moats, but the fact that he's talking about the margins, the pre-tax profit margin, sustainability, and having research, you start seeing that. And that's exactly what we talk about.
Yeah, it's absolutely. All right. And then we've got this again, kind of answering that question. Well, what about today? And Ken, I think this answers your first question about the sales right there at the top.
Don't have any problems with anything on this slide, Mark. All right.
Yeah, and the barriers to entry refers to the moat concept, and this just reinforces all the stuff on the previous slide.
Yeah, I really like what Kevin said about the research also, and I would add one thing to it, Kevin. I find it abhorrent as I watch television, especially the business channels, that many of the people that are speaking are so mathematically illiterate. And I think that right hand in hand with that research is the fact that they know enough about statistics, and they know enough about simple arithmetic, and they know enough about first level analytical mathematics to be able to come up with a model that makes some sense. And they're not just spewing numbers that don't really tell me anything, and that can change on a moment's notice and move in a different direction. So I really like the point you made about this research-based, scholarly approach to studying a stock.
And on that, I have the book open, and it's actually page 156. And after he talks about these growth stocks, and they're all up here right there, is he goes, one of the things that he goes, a third test that's a suitable commitment for long-range investing purposes must pass is protection against a loss of principal, and a cautionary tale should be sounded. The term growth stock is frequently misapplied to enthusiastic promoters to equities of new and unseasoned companies currently registering impressive expansion, but without the assurance of size, stability, or long records of success, or to even speculative stocks that are expected to register immediate rise in the market price. So that's what you see in the 1920s, and that's what we see obviously a lot of times with these IPOs that come on out. And we always hear new people who, when we're teaching the ISSG, like, let me look at this new IPO. And it's just like, okay, what are you going to be able to base stuff on?
Yeah, Brad Perry covers that very well in winning in the investment marathon.
I'll share one other quote that he had from an interview that he did at one other time. I think it'll sound very familiar to what we do in Better Investing. Our philosophy is to find is to buy good quality growth stocks as opposed to undervalued or high yielding stocks or mutual funds. One of the first things we want to do is find good quality growth stocks. Then we want to try to make sure we buy them at the right price. And if you listen to, a Warren Buffett or something like that, price is important to him, but he's learned over the time to find and focus on quality of companies first and foremost, and price as a secondary issue.
Amen. All right, so I thought we would show a couple quick examples just from the book. This table 36 is where he's talking about seeking above average profit margins, and he's talking about specific companies and specific industries. And we draw your attention to section 2A, that column that you see there in the magenta. And it also gives you a feeling for some of the companies. I mentioned Corning earlier, but some of the companies that drew his attention. Any thoughts on these guys? I did go and look up International Shoe.
Yeah, never heard of that. Never heard of that one before.
It's actually Florsheim and Buster Brown, if that rings a bell.
Oh, okay.
I know Ken knows those brands.
But give me a break, okay?
He wore him to school when he was teaching.
I think the only thing that I see out of this is and there's a chart that I've used in some of my classes that I got, looking at decade to decade, the top 10 market cap companies, and how over 50 years, what was a leader 40 years ago is no longer the leader today. And you look at this list and how many of them are still around at some level, some fashion, but some of them are not, which just tells you that at some point, every stock you're looking at might not be something for the future. It might have been a fine thing for the past, but it might not be something for the future. Probably the best one on that list is Eastman Kodak. Though it did change itself to eventually to Eastman Chemicals, and then Kodak was a different company. But anyways, who takes a photograph today versus taking it on your cell phone?
One thing, this is actually a tangent, but one thing that I'd like to figure out one day is how does Fujifilm, how did they survive? And I don't expect an answer right now, but I'd like to compare the two, see what they look like historically. Now, one point that I did want to make with this slide, that percentage of profits plowed back into the business, I think when he was talking about research and reinvesting, I think this is part of what he was talking about. I'm guessing that he's talking about what was not paid out in dividends, was instead reinvested back into the business.
But also that I'm sure they were pulling out. I've seen some stuff like from this era, and when they talk about plowback, they're usually talking about stuff that goes into R&D and not just sort of general overhead, but trying to figure out how much of it is going into, key parts of it. It's more than just R&D. It's other things along those lines. Now, you may even want to put the law department in there if you're a pharmaceutical, because that's also how you plow back and protect your business.
Mm-hmm.
I can't give you the page citation, Kevin, but I can give you the words. At one point in the book, he talks about the quality of employees, and that's something that he wants to try to measure with the reward given to employees that have true value to the whole company as far as originality and ideas are concerned, rather than just working as in doing something to manufacture or something along those lines. But I can't. I wish I could give you the page citation. I can't find it right now.
And another thing is that he also says, and this is on page 265, he talks about you're really being a part owner. I mean, we talk about that when you're buying stocks, you're a part owner. He's talking about that, well in advance of other people that we usually cite for this. I'm not saying that he is the first person to say it, but he was preaching it pretty darn early.
Yeah, and here's another example of that just resonates with us. And Kevin, I'll let you make this point.
So anyway, I remember we were looking at the origin of Rule of Five, and I think there was in the manifest form that someone found it. And when I got the book, I sort of went in there. And here's the thing, we always talk about what the Rule of Five is, and it's, one will do poorly, three will do about what you expect, and then one will do really, really well. Well, the thing is that when he's making this case, he looked at a portfolio from 1951 to 1956, only 6 years, 5 years. But he was using the same methodology for what we just talked about. He says, you have to be able to pick companies that have, again, these growth records and what have you. And he said, look, you're going to probably get 1 out of 5 being a dud, but then you're going to have 1 do really well. Well, the thing is, when he says it for growth, look at that second part of that quote. He's saying that 1 will be disappointing. Okay, 40% will be average, 20% will be very good, and 1/5 will be extraordinary. And you know what? In my own personal experience, I concur with that. I'm not the Rule of Five as it's been sort of espoused in Better Investing, is that we're basically using the income definition of Rule of Five rather than the growth definition of Rule of Five, is I think really kind of the interesting takeaway from this.
That's very interesting.
I guess what I'd add onto that, when I look at club visits, when I go out and do clubs, how often out of a portfolio, out of 15 names, that yes, there's maybe 1 loser in that portfolio, which shows, again, similar kinds of concepts as the Rule of Five, but also that clubs react over time, or investors react over time when something doesn't really work. They don't keep it in the portfolio. They move on and look for something that will replace that for the future. And I will tell you, if I come across clubs that have been around for a while that have, number of stocks that haven't done well, my question to them is about the research process and their purchasing process, because something's probably not working out there if they have a whole lot, because they shouldn't, because most clubs over time react, and most stocks, if you've done a decent job of selection, will be doing okay over time. So
I find that when I visit clubs like that, Craig, a lot of times they're doing more research on the tax man than they are on the stocks that they hold.
Yeah, I'd agree.
All right.
And and on the selling part, on page 267, he talks about when to sell. And it's basically what you were saying, Craig, which is that when the fundamental story changes, you've got to get out of it. We talk about that all the time in our community. And that's, I think, really worthwhile to see that, yeah, he was using it just like we do, like when we do a stock comparison guide.
Very cool. Okay, we've got about 3 minutes, so I thought we would start with Ken's recommendation. And Ken's is kind of an unusual, unique, magnificent mathematician. He apparently reads books backwards. So go ahead and explain your justification.
This is 287 is 3 pages from the end of the book, and I would suggest that this is a book with a lot of very interesting, valid points being made throughout the whole thing, but it's a very difficult book to keep your eyes open on a lot of times. My suggestion is you start with the conclusion on page 287 and read those 3 pages first, because if you can't read any further after those 3 pages, I think at least you've gotten the core of what Babson is trying to say in the entire book, and he captures it in these 9 points, which I think we're going to even condense a little more in the next slide.
No, I think that's it. We're down to...
Well, and as we talked about this last night, the preface is pretty much the same as the conclusion. He's basically reinforcing with the conclusion what he starts out with. And I was going to leave, there's a couple things on page 282 over the next 3 pages or so. He has 6 common sense guides to investing. Know your own mind. In other words, what's your plan? Or you need this for income or do you need it for growth? Ignore the second one is ignore the short-term trend. 3 is know about the companies and stocks you own. 4, diversify selectively. 5 is pay for what you buy. That means not buying it on margin. And then he says 6, invest with regularity. If that doesn't sound like a precursor to our principles, I don't know what is.
Agreed.
Agreed.
I'll make it unanimous. Okay.
Nice choice, Kevin. I think it's a launch to we can dig into some of these concepts even more deeply with some of those other legends and lesson providers. Good stuff,
Well,
guys.
Mark, I think we've done a really wonderful job of condensing the entire book to our 50-minute time slot. We're almost exactly at 10 to the hour right now, and we have our audience gathering for the roundtable. So now's a great time to ask a question, make a comment. Marianne would like you, oh, this is one of our new directors in mid-Michigan. Marianne would like you to repeat number 3, Kevin, if you could.
Oh, on that step? Okay, I just closed my book. I got to find my page. Let's see, I think I said 282.
282.
All right. All right, so 6 is invest with regularity. Is
number
3.
three.
You wanted 3. Know about the companies whose stocks you own. Basically, know what you own.
Yep, one of the prime characteristics of an investment club, right? We gather together in a group so that we can share the burden of our research. We don't have to know about 15 stocks. We can know about 1 or 2 and trust our partners to help us out with the rest.
Underneath 3, it says here, I'm using the second sentence. Many investors spend more time watching the day-to-day changes and quotations on their securities than in studying the progress of the research work, new products, earning power, basically a moat, dividend paying ability of the companies whose stocks they own. It is human nature to be interested in following daily quotations, but is not particularly profitable habit, nor in itself does it lead to an effective investment results over the years. That's number 3. Know what you own.
I can give us a little bit lighter comment on that, Kevin. Our friend Hugh McManus from Pasadena, California, says to be very careful of watching too much financial pornography.
Was he talking to you, Ken? You're always
No,
telling us what you see on the news.
But I know what it is, and I'm watching it for entertainment purposes.
Okay, that's what you're telling us. Okay, fine.
Well, he first made that comment, as I remember it, walking the halls of the Money Show.
Watching people claiming they had invented a logarithmic graph paper, right?
And I love the Money Show, but you have to be educated and know what you're wading through. It would be WADING.
But agree.
We do have about 7 minutes now, and it's a great time. We're getting more of our audience joining us at this particular time. So if you have a comment, a question, or anything else, I'm going to give a great round of applause and thanks to Kevin Galogli and Craig Bramer for helping us out in our initial fireside chat. That was the original name of these things, and then we decided to leave Roosevelt out of the equation, so we went to Campfire. And we're just going to be talking about these topics, whatever is of interest to us, and we hope whatever might be of interest to you going into the future. We're going to start out with trying to do these at least quarterly, and if they catch on, and if we have enough people that think we have enough topics, then we'll even do them a little bit more often than not. Thank you for your kind words, folks. We're seeing some people making some comments now in the question box. Now's a great time to lighten us up a little bit. And if you have a question or a comment or something you'd just like to get off your chest about investing, now's our time. We're in the Mid-Michigan chat portion of our roundtable, and we have 5 minutes to chat with you, unadulterated chatting. So whatever you'd like to speak about, let's keep it focused on investing if we can, okay?
Well, one quick thing, Ken and Mark, I don't know Fujifilm well, but one thing that they did I understand that Kodak essentially rejected the digital revolution and said, we're the leader in film and film's here to stay. Fuji both converted much of even their, quote, film, if you will, to digital media, but they also, I don't know if they were in the film camera hardware business, but that's what they're heavy in now is digital lenses and cameras and the like.
Okay.
For those of you that don't recognize those dulcet tones, that's one of our Knights of the Round Table, Cy Lynch. And Cy has joined us in the back room right now. We're getting ready to make our roundtable presentations. I have a comment about Fuji Films as well, Mark. My uncle was a professional photographer during his entire retirement, and he continuously made the points that film would never go away as long as there were people that wanted to make art with the camera. So for whatever that's worth, that was a quote that kind of stuck with me about the concept of film versus digitization.
That's true, but it's only the hardcore hobbyist. It's a smaller slice. You know,
Matt Spielman. Matt Spielman wrote in the question. He goes, "Kodak rejected digital imaging despite inventing it."
Yes.
That's true.
Thanks, Matt.
Yeah, that's true.
Yeah.
Well, this is certainly a very restrained audience. Usually we get more questions than we can possibly handle. Folks, you still have 3 minutes because we're not going to start early, but if you have anything at all, talk to us, interact. This is a time when we can maybe kind of sort of approximate meeting face to face. And most of you know how much Mark and I miss meeting face to face. I can put a plug in for the fact that if you're anywhere near the eastern suburbs of Cleveland this coming weekend, Mark and I will be speaking to the Northeast Ohio chapter in person at the South Euclid Library in Mayfield, Ohio. If you have any ability to get there and have a free Saturday morning, join us. The event is free, and we are just looking very much forward to having a full house and to speaking to people and actually seeing their reactions in real time.
Ken, I have been advised that they're not going to allow us to build a fire in the middle of the conference room.
No, I know that already. They've told me to.
No book
smoke.
burning.
No
book
smoke.
burning.
No.
We have a couple questions in this thing. Jacqueline is asking, how much emphasis should be placed on sector diversification?
Ooh.
Yeah, I'll take it. Go on, Craig. Yeah, go on, Craig.
I'll just touch on his comment of wanting to find sectors that have growth in it, that have real growth. And so a lot of the misnomers I find when I look at stocks and with my club members is it has growth for a period of time, but it actually acts much more like a cyclical company over time. So the question is does it really have growth, or is it just doing a little bit better than average for a short period of time? That's a little bit away from the question of how much sectors you should have. But when I've done my work in this world, if I'm looking for growth sectors, I think there's only 4 or 5 that are really growth sectors. There's a couple more that have growth in them. You have to hunt them out. But there's a couple sectors that just don't have any real growth at all, I don't think, which maybe goes to the next question about any thoughts on energy or utility stocks.
Yeah.
The ones that are growth in the energy utility stocks are all tied to, electricity demand, tied to AI demand. And, maybe that all comes true. I don't really know. I do know that there's a lot of utilities in this country are running tighter supply on their supply of energy. So eventually they're going to have to build more plants.
Mm-hmm.
But if I understand quantum computing at least a little bit, if that actually does work, then I'm not sure why you need all these AI factories. But I don't really know if that's going to work or not. And as Jensen Wong said, that's about 10 or 15 years away before they figure that out. But so sectors, I mean, focus on the growth sectors, and I think you do need diversification. But I do sometimes see clubs that are over diversified, or they'll have 8 different sectors, and
Yeah.
I'm going, do they need 8? So anyways.
I'm going to address Barbara's question. She says, can somebody explain step 3 on our slide, which says savings and investing ultra conservatively for long-term needs exposes people to shrinkage? And Barbara, I think what Babson is saying at that particular time is that if you were to put all your money into a savings account
Or a
or into
mattress.
bonds or a mattress or under the rug, if you were to do that, then inflation would shrink the value of your holdings, and it would do it consistently and forever. And that's exactly the point that he was making about looking at growth stocks, that you had to not only grow enough to meet inflation, but you would like to grow a little bit more to outpace inflation. That's the explanation, I'm pretty sure. Kevin, would you add anything to what I
that's
just...
exactly it. And he even uses examples of like $1 in 1940 and what it's worth when he wrote this in 58, and it was already half the value. It was only 50 cents. So again, he starts his book out with that first chapter about how you have to be able to keep up with taxes and inflation, and you can't do that with just income from a bond.
Most of you in the audience can get a chuckle from your kids or your grandkids by telling them what your first salary was per year. And that's a real stark understanding of what inflation is over the time period from then till now.
All right, Ken, I have 7:01 if we are ready to roll with the traditional roundtable.
I think we are, Mark.
I think Craig and Kevin are going to stick around, but thanks, guys. Wonderful contribution here tonight. Thank you.
Let me count to 3. Let me count to 3, and then we'll start the recording, Mark, okay?
Go ahead.
Good evening, everybody, and welcome to the Mid-Michigan Manifest Investing Roundtable, the September 2025 version. My name is Ken Cavola. I'm a director with the Mid-Michigan chapter, and I'm joined this evening by my really great friend, Mark Robertson, who's also a director with the Mid-Michigan chapter, and Cy Lynch, who's a volunteer extraordinaire for better investing. Cy has served in so many different capacities, most recently as chairman of the NAIC board of directors that oversees the whole better investing company and community. So, gentlemen, welcome to the roundtable. Folks in the audience, we're so happy to see you today. And we just finished our session around the campfire talking about growth investing. And we're now moving into a very typical roundtable session. And we're going to try to keep it going and try to make sure that we're finished by somewhere close to 8 o'clock this evening, because we did begin at 6 for this very special event. This is our demonstration that we're going to do monthly in the Mid-Michigan Manifest Investing communities. This is an educational demonstration with no investment recommendation intended. Do your own homework, make your own decisions. Everything that we talk about are examples of what we would like you to follow up on your own time, with your own choices being made as to what you're going to add or subtract from your own portfolios. If you'd like copies of our slides, send a request to Mark or myself. Those are our emails down at the bottom of the slide. If you have questions or concerns or comments about the session, send them to either one of us as well, and we will try to get an answer to you. We just urge you to remind yourself that I'm a complete volunteer, and when Mark's doing business for the Mid-Michigan chapter, he's a volunteer as well. So we'll get back to you, but it might not be within 2 minutes of when you send us the email. Mark, let's go. I also would like to remind you that if you're not getting monthly notices from the Mid-Michigan chapter, We don't advertise through the entire mailing list at Better Investing, but we are allowed to advertise to our chapter and to our guest list. If you'll go to the Mid-Michigan chapter, and there's the URL Mark just pointed at, if you'll go there and then scroll down to the bottom of the page, you'll see a little form where you can subscribe to our guest list. We promise we won't bother you with more than 1 or 2 emails a month, just reminding you of the roundtable and when it's going to be, and also reminding you of any other special programs that Mid-Michigan might be pulling together and then presenting to our members and to the guest list that we maintain. I'm often asked how many folks are on the guest list. At last count, we had about 2,500 people on the guest list that we mail out our emails to. Here's the roundtable portfolio. We hit a low a couple months ago with our performance, but we were still beating the market by almost 2 points at that particular time. Since then, we've begun to rebound. We'd love to be up around that orange line. That orange line suggests that we'd be beating the market by about 5 points. And this graph goes all the way back to our beginnings about 16 years ago now. We're well into our 15th year, going to be celebrating our 16th anniversary real soon. We'd like to get back up to 5, but I'll tell you, when the market's humming along at 20, 21, 22% or thereabouts, it's very difficult to beat that market and to do it with a once a month meeting as we're trying to manage this particular tracking portfolio. We do have non-core selections in our portfolio. That's a very a neutral word for saying that we're not adverse to buying something on price to hope, but 75% or more of our portfolio is devoted to up, straight, and parallel, and that's what we'd like you to focus on as well. We're looking to outperform the market by about 55%, and our outperformance accuracy for a moment got up near 55%, and now it's dropped back to a little bit more than 50%. So we need a couple of those stocks that are just barely losing something right now to move back into the positive zone, and we'll be okay. Mark, you're trying to get in, so I'll let you. Go on.
The great humiliator is annoying. There's no doubt about it. I did receive some correspondence I want to share because it's kind of the answer to a question. You know, we believe and we know that it's prudent to have a pretty good representation of medium-sized and smaller companies. We do that. We try to do that at the roundtable. It's not a perfect process, but we do certainly welcome smaller and medium-sized companies. Those companies have been absolutely massacred over the last couple of years, and that is a plausible explanation for some of the sag you see in this relative return, because some of the very large companies have kind of taken off, and so that has put a little bit of a dent in our portfolio. So we think it bodes well for the future. The last few weeks, last month for that matter, has been better for the smaller and medium-sized companies. So I just wanted to make that point. It's a credible and plausible explanation.
I will also say something, Mark, that I don't often say when we're looking at this slide, and probably we should be saying much more often, and that's that the +5 goal is an extremely aggressive goal. It's not easy to beat the market by 5 points, and maybe we took it for granted from year 7 up to about year 13 and a half or 14 when we were able to do that. It's an aggressive goal, but you should be very proud of yourself if you can beat the market even by 1 percentage point. That's not common, and it should be something that you celebrate on a regular basis. That orange line is the stated goal, but again, it's an aggressive goal. So keep that in mind as you beat yourself up for not reaching that +5 when the market's doing 20+.
And I just threw some numbers on the slide for you. If you're talking about the institutional funds that are beating the market by 5 percentage points, there's 20 of them. And out of the universe that we cover, and that's 650 funds. So 20 out of 650 actually are operating at or above that orange line. So that's the rare company we hope to rejoin.
That green line, we're getting a question mark about what that green line is. That green line is just the 0 line. I think that's what you might be pointing at. I'm not sure that it's green. It might be black, but it's coming up green on my screen.
It's green, yeah, that's 0. That would be market performance.
Yeah, and that red dotted line way down at the bottom, that's
the average institutional fund.
Yep.
Average.
Did you all hear that? The average mutual fund and or exchange traded fund is averaging way down there and by that red line. So don't beat yourself up if you're only 1 up on the market in today's market.
Yep. Here's a look at the top 20 holdings in the portfolio, listed by percent of total assets. You can get a feel for some of the characteristics. You can see that Microsoft is obviously one of our pets. The legend up at the top provides the number of times it's been chosen by either a knight, a damsel, or the audience. Every time that one of us makes a nomination, we put $1,000 into the company. So in the case of Microsoft, Microsoft has actually received $1,000 5 times. So $5,000 invested has become what you see here, about $130,000, and that's fun.
And if you don't see a company on the legend up at top, that means we've only chosen it once. And in our top 20, that would be referring to Costco, which unfortunately we've only bought 1 time in our history.
Yep. And we always want to be pressing to get this overall portfolio par up. That's another reason that we've sagged a little bit. The overall portfolio return forecast is basically at 10. We would love to see that at 12 or 13 or 14, and we continue to work towards that.
And that par value goes hand in hand with that growth number. That's a sales growth number coming from the analysis that's done on every single stock that matches the analysis exactly the same way that we do a stock selection guide. That would be the par value on a stock selection guide or in Manifest. And you don't move that par value on the top line up very far unless you keep that growth accelerating. And we have set ourselves a kind of ambitious goal. We'd love to see that growth number up closer to 12, 12.5 than down around 11 right now.
Mm-hmm. So we'll keep pushing on, but enough for that. We've been at this long enough tonight. Let's go ahead and talk roundtable. Once again, I would just like to pay homage to the people who voted for Brown and Brown a couple of months ago. And the cheetah was the recommendation by my grandson, our grandson, and just thought I'd share a picture of Logie. And he is taking requests for other animals, which might help me in the future for future stock nominations. So you can always send me a note and give Logie a suggestion. Trust me, he can find pictures of baby animals in just about anything. So there you go. There you have it. That, by the way, is the corporate mascot of Brown and Brown. And with that, let's go ahead and talk innovation.
Looks like I'm up first tonight, so I'm going to present to you Innovative Solutions and Support. The stock ticker is ISSC. And this company is a fairly new company to my repertoire. And I will tell you that I own a few shares of this particular company, a very few shares of the company at the moment. Next slide, Mark, if you would.
And it is one of our best small companies for the current year.
I forgot to mention that. It's on our current best small companies list, and we're coming out with a new list on Halloween. I think we have a session scheduled for either November 1st or 2nd, and we'll get to those dates later on. ISSC is a US-based original equipment manufacturer, OEM for those in the know, and they make many things that go on to modern airplanes, both commercial and military airplanes. They focus on the cockpit, but they have many other things that they can do as value added or added on features, and they can add them to planes that exist or they can sell to the OEMs and have them incorporated in the original design of the plane. And I've just captured a few of the companies that ISSC works directly with to come up with different types of solutions to different kinds of problems. Next slide. IES likes to brag that they are a fully integrated company, which means that they do everything when it comes to putting something into an aircraft. Again, fleet modernization, that's adding things to an airplane. Retrofitting, that's changing something that didn't work as well as the new thing might work. And then, of course, adding things to commercial and military aircraft as they're being manufactured. This modern integration, next slide, starts with designing the products that they sell, and then sourcing the materials for the products they sell, and then manufacturing the products they sell. They do not source their designs out to other companies to manufacture. ISSC manufactures them themselves, and then offering comprehensive long-term support for the products that they sell. The quote right there is directly from their investor presentation, which contains an awful lot of information that you might find very interesting if, in fact, you're going to be looking at ISSC as a possibility for your portfolio. This vertically integrated model, they feel, makes them extremely efficient in controlling quality. Next slide. Here's an example of some of the kinds of things that ISSC will put into a cockpit. Everything from sensors to receivers for video and for voice. They have co-pilots, things that fly the plane. They make screens, different types of displays for different types of applications. They do many, many things that you would never even think of adding as an add-on to a plane. But when you sit back and look at the complexity of an aircraft cockpit, you realize that there are hundreds of different components, each one of them having a very specific job to do, and each one of them having to be manufactured by somebody, not the people that put the airplane together. The product portfolio is very specialized, and they offer equipment and sourcing to almost every single aircraft manager on the planet. Next slide. They recently acquired from Honeywell, the Honeywell Aerospace division. So that whole division was purchased by ISSC in 2023. They got a lot of communication equipment, a lot of navigation equipment, and inertial technologies, which give you an idea of how the plane is flying, whether it's level or upside down and things like that. The transaction expanded their product portfolio, and it gave them upgrade opportunities in a lot of military aircraft. You can see the countries that fly that particular military plane, for example. And it also increased the opportunity to add to specific airplanes on different platforms in some of the major airplane manufacturers like Boeing and Airbus. Next slide. ISSC went through in the last 3 or 4 years a real thought process about what they were doing and then what they wanted to do. And the 3 points off to the left of the slide are what they had been doing in the past. They were a very small company with limited economy of scale. They were focusing on pure organic growth, and they were heavily reliant on the cyclical commercial airspace. They didn't have much presence in the military arena at all. They decided to change their focus and now they're targeting commercial expansion. They're looking to upgrade what they do, not only organically, but do it by acquisition when appropriate. And they're hoping to achieve different economies of scale by increasing the size of the company and give them more opportunity to cross-sell various items and to relate one item to another as they pitch to various contractors. Next slide. You know me, it's up, straight, and parallel, with a very decided increase in both sales and earnings in the more recent years. You have that beautiful kind of upward trajectory going on for this particular company. Look at the most recent quarter, folks. That second quarter to third quarter slope doesn't look very impressive until you look over on the right and note that that's a 55% increase. That's a pretty decent increase going on. Sales were up 105% for the trailing 4 quarters during that same period of time. You'll notice that I've come up with 20% growth and 20% earnings growth as well, and that earnings growth would give me $1.64 5 years from now. Kind of keep that number in the back of your head, although I will repeat it once or twice before we finish. That's about as far as I usually am willing to go for a company that doesn't have a lot of analyst coverage. And ISSC does not have a lot of analyst coverage. So even though that 20% does not come anywhere close to matching the most recent quarters for the company, it is something that I think is consistent with the last 4 or 5 years growth for both sales and for earnings. Next slide. Here's the back of the SSG. At the top, you can note the high and low averages. I did exclude the COVID year when the numbers went kind of screwy both to the high side and the low side during the beginning of the COVID pandemic. But you can see the last 4 years, the averages have been around 27 at the high, 16 at the low. And you add those two numbers together and you get around 22 for a 5-year average. The stock is currently trading at a 17 PE value, considerably beneath its last 4 years of performance, but I've decided that that 17 is a reasonable number going forward, and you'll note that I'm using a 22 high PE and a 12 low PE, much more closely aligned with the 2024 numbers, and that gives me an actual number of 17 when I add those two together and divide by 2. You'll notice this extreme conservative choice of PE values, not relying on the averages, but lowering them quite a bit, still gives me a buy for this company with a potential price appreciation of over 200%. Next slide. Here's the manifest investing page, and you'll notice that Mark gives this company, Mark's database gives this company a very high quality rating of 94, par value up close to 30. The orange background indicates that that might be too good to believe, but let's keep it in our minds, at least for the moment. Mark's database is estimating future sales growth at more than 38%. I've circled it right there. Remember that I've estimated future sales growth at only 20%. That's almost half of where the analyst community is. So again, this is an extremely conservative stock selection guide. That 38% sales growth for the next 5 years would give you a preferred procedure earnings number of about $4 a share. Remember that in my analysis, I was only coming up with $1.64 a share 5 years from now. So again, extreme conservatism on the stock selection guide. Next slide, Mark. Well, with that very extreme conservatism, I'm still getting an upside downside ratio of 7-to-1 on the company. I'm still looking for a par value of close to 20% and a best case scenario, maybe up into the mid 20s. That best case scenario approaches very closely Mark's par value of about 29 or 30%. So I think this is a reasonable, albeit extremely conservative stock selection guide. I think most of the challenges will be to not to the downside for this company, but it will be my underestimating the performance of the company going forward if they stick to their plans to reinvent what it is they do as a company. In other words, if there's going to be a surprise, I'm guessing that the surprise will be numbers higher than my 19.6 par value. Next slide. So let's add another $1,000 of innovative solutions and support to the round table tracking portfolio. Thanks for your time.
Thanks, Ken. All right. Well, I'm hungry. Are you hungry, Si?
I certainly am. How about some peanuts, Mark? I guess we should have put that on the slide. But
I have some Georgia peanuts.
well, there you go. I was eating some Georgia peanuts last night at the ball game.
There you go.
Not at Texas Roadhouse, but here's Texas Roadhouse, and you heard Ken talking about up, straight, and parallel, and this is pretty much as close as it gets to that. And you see a little bit of the value line projections or possibilities for the company in the midterm, year and a half or so out, potential 30% return, and you'll see varying around the doubling or a little over doubling potential here on the 3 to 5 year. Next slide. I came up with Texas Roadhouse just by going thinking this month it might be time to look at the portfolio and see what's out there. So I ranked the roundtable portfolio by par and just kind of skimmed it down both on familiarity with companies that I had or just my interest in them. And Texas Roadhouse kind of jumped out at me. Also, I think it's about time, because I first brought Texas Roadhouse. It's been presented twice and grown to $4,000 over 6 years that it has been presented. First time back in 2019, then in 2022. So it's due for another time in 2025. Good high quality and potential return. Next slide. I did a quick industry study, ranked first by par, that you can see here, and you'll notice that Texas Roadhouse is the highest excellent quality rating by par. Chipotle and restaurant brands are fairly close in both par and quality, especially Chipotle Mexican Grill. Then ranking by quality in the next slide just gives you a little bit different perspective. Again, you see Chipotle there, but then you've also brought up some of the other excellent quality companies, most of which are not in the sweet spot or are above our goal of 5 above the median market potential return in the manifest database. Next slide. Here's just a quick review for a refresher for those of us who have seen the company or covered the company or owned the company or eaten at the company, and just a little bit perhaps of an update from the earlier. It's a casual dining restaurant chain, been around for a little over 30 years, has right at 800 restaurants in 49 states, Puerto Rico, and 10 foreign countries. Notice that the vast majority of companies are a Texas Roadhouse with, of course, steaks and peanuts. 52 are Bubba's 33. And I left sports bars in here. I'm not sure. I mentioned, give you a little bit more detail on the three concepts in a couple of slides. I noticed that the company's not using the word sports bars now. They seem to be going a little bit more toward music and sports and family casual dining in burger places, if you will. And then they have some Jaggers fast casual, which is more of their think Chipotle and that type of service restaurants. And also of those 800 restaurants, the vast majority of those are in the United States. They have about 58 international, most in the Philippines and South Korea, but as you note, they're in 10 foreign countries. Also, the vast majority are also company-owned restaurants. They operate 118 Texas Roadhouse, or they have franchisees who operate 118 Texas Roadhouse and Jaggers restaurants. And they are slowly buying back some of the franchise restaurants. I'm not sure that that's a company strategy. It may just be buying out weaker franchisees, but that are the restaurants are in areas that they want to continue in, or perhaps transition type plans. But they are buying back in the last couple of years in the 10 to 15 per year range. Next slide. Just a couple of the latest annual reports. There's the peanuts picture that I could have moved up at the very beginning, and just legendary food, legendary service is kind of a underlying motto of the company. Next slide. They mention in their latest quarterly or annual report that they were the first casual dining restaurant to be named as a brand icon by the one of the trade magazines, Nation's Restaurant Reviews. Next slide. Here's the additional detail that I'd mentioned earlier, just giving you a bit of an idea on the menus for the companies. And notice Bubba's 33 from the last time that we featured it they're not terming it a sports bar. They're saying scratch made food with a little rock and roll beer and signature cocktails. And then you see the menu. Next slide for Jaggers. And they're opening about 30 new locations a year. That's what they expect. That's what they roughly what they opened last year, what they expect in fiscal 2025, and again in the relative near term. Next slide. Are we freezing, or there we go? All right. Again, just you've seen the graph before, but I've now added the actual numbers underlying the graph that you can see the actual figures as well as the historical growth rates for sales, earnings per share, and pre-tax profit in actual percentage numbers. And there you could see the outstanding management evaluation for those of us real old timers, the Section 2 data, well above, nice increases, well above average currently. And you will notice again back in 2019, a significant increase in the debt to capital ratio. That's when the accounting rules changed and required companies that leased real estate to put their real estate leases on the balance sheet as debt. So that's not that the company changed their balance sheet or changed their business practices. It was just an accounting change that caused them to bring more of their, or bring their leases on debt, making them carrying more debt on an accounting reporting basis, but not actually changing the company's business. Next slide. And here are my key judgments. I'm projecting a future growth rate of about 10%, which is roughly in line with the Morningstar consensus, ACE consensus estimates of analysts. It's roughly in line, maybe a smidgen above the Better Investing median expectation. And also for any sort of retailer, be it retailing goods, retailing or retailing food, like restaurants, another measure of how the company's doing, and a way to look at their potential growth rates are combining how they add units, add restaurants, plus how they increase revenues at the restaurants. That's called comparable sales or same store sales. It's looking at stores that were open, or restaurants in this case, open a year ago, and how they did. In the last quarter, their comparable sales were up by 5.8%. And they're projecting, I mentioned the roughly 30 new restaurants, that is around 3.8%. You add those two together and you get about a 9.6%. So potential growth rate, again, roughly in line with the 10% that management and analysts are expecting, and that I've gone. It's a little bit under the manifest consensus. That's closer to 12, which is, again, closer to the historical. I think anywhere in the 10 to 12 range is probably reasonable for this company, but they are going to be facing some challenges they anticipate, which is inflation in labor and food, and they do have some tariff impacts, both because of their international operations as well as some of the food products that they import. But then you can see the other judgments for the pre-tax profit and tax rates. And then shares outstanding, they are slowly buying back shares. So I'm in line with the value line and manifest projections there, leading to potential earnings per share of $10.19 5 years from now. Next slide. Those judgments, coupled with a potential high PE of right at 30, and a potential low PE of 20, or excuse me, average PE, low PE of 17, and average PE of 23.5, leads to potential total return of 15.2, using, oh my goodness, 23.45. I'm off a little when I said 23.5.
That's good.
But it gives us a good 15% potential return, or using the average PE gives us a potential 10.3% return, and that's to be compared to the manifest par of 15.4, which uses a little bit higher growth and significantly higher net profit. I'm going to say one quick thing, kind of just a jump out your kind of free learning point, or my free teaching point for the night. I think in theory, par or calculating potential return using an average PE rather than the high is theoretically the best way to do it. And that's why I like paying attention to it. And I like the manifest methodology. And I think you may see in some of the manifest methodology the flip side of what I'm about to say, or the manifest application of our better investing methodology, SSG methodology. I think most of us in the better investing community come up with abnormally low par values or forecast average PE, total return values. And we do that because it's ingrained in us to be conservative in our growth estimate, our PE estimates, and our profitability estimates. And if you've already built in margin for errors early on, then you're putting a double margin of error, especially in the PE area, by using the average PE. So maybe if we could kind of change our mindset to be a little less building in what we call conservative SSGs up front, as in this case, Manifest has a little bit higher growth rate and a somewhat higher net profit rate, then you get perhaps a better, so to speak, par result. And notice in this case, and it's sheer coincidence, but to kind of reinforce what I'm saying, notice that the Manifest par is 15.4, which is almost identical to the total return that I get using the high PE. So again, slightly different application, but we get to very much the same place. And with that, I suggest that we add another 1,000 Texas Roadhouse to the portfolio.
Very good. Good company. Definitely up straight and parallel. I thought you'll enjoy that picture, Si. Well, maybe not.
Absolutely.
Maybe
well,
enjoy.
yeah, Barb's been lamenting how we've got just one more game that we're going to, so we're kind of not quite ready for the hot stove league. But
well,
you notice the weather out the window, don't you, Si?
yeah, yes, I do that too.
Well,
and that's real scary here in Georgia. Real scary.
You, as a Cleveland Indians fan, you can't relate to this, but at this time of year, Si and I are used to continuing to play baseball.
Oh, shush.
Cardinals. All right.
The Guardians. No, I'm sorry. What are they called now? They're called something different.
Did I say Indians? I'm sorry.
Yeah. No, Guardians is right.
Was I correct? Okay, Guardians.
Yeah,
right.
You were right.
All right. Baseball frivolity aside. And now for something completely different. By the way, here's your reminder that Landman returns season 2, mid-November. and I don't think his finger will be back. All right. Going to share an idea inspired by a couple friends of ours. I love the work of Susan Jabinski. She's there on the right, and David Sakara. They have a regular program that they present ideas, and I just thought I would demonstrate listening in and wondering if anything there might be of elevated interest to us. I'm also going to demonstrate that we can talk about growth investing and high quality companies for an hour or so. I'm here to prove that I don't listen and I don't follow instructions well. So with that, here's the companies they presented this week, I believe on Monday morning. I presented Fortinet last month, I believe, for the roundtable. Is that correct, Ken?
I think so, Mark. Yeah, I think so.
So I probably would have been drawn back to Fortinet in the absence of any other influence. But I also want to point out that Susan and David are zeroing in on a couple of those medical device companies. I find that fascinating. Crown Castle, I have no idea what to even think about, so ignore that one. And then there's this Devon Energy. And like Ken said earlier, maybe not tonight, but certainly before, we have a rough time with these energy stocks. And I would only go there if I thought there was a reasonable chance that they were really, really on sale. because we're talking about a company with a slower growth rate, much like Craig Bramer was talking about in the earlier session. There are a lot of times the companies in this sector or industry are slower growers. So you're basically talking about value plays. I do not do very well with them. But hey, if Jed Clampett can nail one with his musket rifle, I say we go for it. All right, much like Ken often does, they have a good investor presentation if you want to actually get a feel for this company. We love the people of Oklahoma City, so that's another feather in their cap. The ticker symbol is DVN, as you see there on the lower right. And again, they give a pretty good rundown. I'm not going to go through it. You can go and get your own tour of the company. I will point out, here's one of the slides. And the reason I put this one up is a few years ago, we did a presentation with the guy from First Trust, Jim Bowen, and he made it quite clear that that is pronounced Eagle-Ford. Not Ford, Ken. Eagle-Ford by the people down in that area of the country. And this is one of the areas where they are active in the oil and gas exploration and production. They also have stuff in the Permian Basin and over towards the Texas, New Mexico border. They have production facilities and exploration in Colorado and in the Dakotas. So they are pretty diverse up that center stripe of the country. And they're talking about this one here, which is down fairly close to the Gulf. Okay. Here's a look at the company over time. It does not have the strongest quality due to the cyclicality and perhaps maybe a little bit lower financial strength over time, but it's not terribly unusual under present conditions. We're talking about a growth rate of roughly 4%. That's what you see here. And again, that's not setting the world on fire, but that it is expected to be fairly consistent, and that aligns with a lot of what is expected in the energy markets going forward. They do have an erratic earnings profile, and as you can see, when we talk about the stock price following earnings, it's true. And so when you see these 2 points here where the earnings disappear from view, that explains what happened to the stock price. So if that happens the day after tomorrow, after I get done picking this stock, if the earnings actually disappear, the stock price will continue down. We know that. That is not the expectation right now, but that is the situation. We do have a situation here where the projected annual return based on a PE of roughly 21, we'll take a look at that, is about 30%. The projected return on value, which basically encapsulates all of the capital structure of the company, all of their obligations, and all that kind of stuff, checks in and aligns pretty closely with the projected annual return, the result of your stock study. And with a earnings per share trajectory like you see here, this probably makes a lot of you uncomfortable, but that's just a fact. That's what it is between 21 and 29. Okay, the one thing that is compelling, and Cy and I have talked about this over the years, how do we ever know when to really go after these things? At least we're dealing with a situation where, based on the expectations that we lay out for the company and that they lay out, we're dealing with a many multi-year high projected annual return. So that might actually introduce a little bit of a factor of safety. Ken will argue that it's not reasonable. That's okay. That's his opinion. Okay. So here's that situation. The earnings disappear, but the cash flow didn't. So you can actually measure the cash flow. This is why George Nicholson told us for companies like Ford, not Ford, Ford or General Motors or other companies that are deep cyclicals, it was okay to look at the cash flow instead of the earnings, just to get a feel for how the company is doing over time. Those periods when the earnings disappeared, they're down here with cash flow. You can see they are the lowest cash flows on the chart. This is the reason the value line does what they do with price to cash flow instead of price to earnings. They don't ignore earnings per share. They don't ignore PEs, but they factor in price to cash flow and cash flow characteristics in any work that they do. All right. Profitability over the long term is extremely important. We spent the whole hour talking about that leading into this session, and this is a very strong looking picture. This trend is absolutely strong and in the right direction. These pressures right here in the operating margins, for whatever reason, whatever's going on in the economy, is what has put a lot of pressure on the stock price. But the projections are for it to recover and probably parallel this green trend line a little bit more. Is a PE around 20 unreasonable? Because these guys have been running around in the high single-digit range for a number of years. But it's not unprecedented. Back here, under operating conditions, which we are hoping for, increasing trends going into that, again, PEs in the 20 range were not unprecedented, and they certainly are not impossible. So here's a couple quick looks, and I think this is really what underscores, we talk about all the electric vehicles and the hybrids and all that stuff going on out there. There's still going to be a lot of internal combustion engines on the road. We have a hybrid van from Stellantis, and we probably won't go away from that anytime soon, but we will probably have an internal combustion engine in our garage for a long time to come. The average age of cars is 14 to 15. That's one of the reasons that we like Copart and some of those other parts companies. But the other thing that really gets neglected and not really thought about, I call this the Len Douglas cause or initiative or awareness. There's just a whole lot of places where petroleum products get used, and it isn't in the gas tank of an automobile. And that demand is not going away anytime soon. Hence the Landman reference where Billy Bob Thornton points out that there is no substitute for this. There is a demand for all of these products. People like to wear coats and take pills and operate keyboards and computers and all that kind of stuff. It's not going away anytime soon. So there is a relatively constant but fluctuating demand for petrochemical products. And that's not going to disappear, and probably not in most of our lifetimes. So that is what's factored into that longer term analysis. The spot markets can be crazy, but the longer term perspective probably makes a little bit of sense here and might be worth getting a little bit crazy with a non-growth company. So again, clouded energy markets are doing this. This is the value line close from the fairly recent report. Basically, the near-term outlook for the company looks pretty good for the next year. But even beyond that, and based on probably something very close to the comments made by Sakara, Dominic is basically pointing out that there is a legitimate long-term potential for this company also. So I like it. Again, it's kind of the roll of the dice. They don't always work out. Also from the Landman TV series, and there's one that didn't do so well. And that could happen. Or this could happen. And anybody who wants to place their vote and their confidence in my $1,000 nomination of this company tonight is welcome on the Beverly Hillbillies mode of transportation that you see there. And by the way, this is a nice little fun fact down here. Now, if that's leaking oil, that's built up demand, right? It's built up demand for the products we're talking about. If those are potholes, it's also pent up demand for the asphalt, which needs to repair those potholes. So it could be either one and still work out okay. So with that, I will nominate Devon Energy, ticker symbol DVN, for addition to and tracking in the manifest or the roundtable tracking portfolio. So Ken, there you go. I don't follow directions or pay attention very well, but there you go.
Well, the poll is open, Mark, so we're asking you to vote, folks.
I know that about you. You don't follow directions.
We'd love for all of you to take a chance and vote for us. Go on, Matt.
No, that's fine. Go ahead and start them off. I'll fill some space after.
Okay. We'd love to get you up to 80% voting if we could, even 90%. We just crossed 65. That's 2/3 of you. It doesn't take anything. We don't charge you anything. We just are asking you to make a choice as to which one of these three might you want to put in the portfolio. To be very honest, I forgot to prepare the poll. So I was busy doing that in the last 15 minutes here, and I forgot to give you the choice of none of the above, and I apologize for that. So I guess if you're not voting, you're voting for none of the above then, okay? We're almost up to 80%. Let's get 8 or 9 more of you voting, and we can maybe hit that 80% mark in voting.
None of the above is usually the last on the list, so if that's what you're inclined to do, just choose the last one.
Okay, Cy. I'm going to kind of count to 10 in my head. If you've already voted, thank you. And if you haven't voted, why not? Make a vote. It doesn't cost anything, and it's a little bit of extracurricular activity at the end of a session here. I am going to close the poll now, and I'm going to report that Mark is not going to be as happy as he was last week, okay? Looks like Innovative Solutions and Support will get an extra $1,000. Texas Roadhouse had about a fifth of you voting for it, and Mark, you got 1 or 2 votes there.
So in other words, a blue-eyed leopard, or I guess that's a cheetah, is much superior to Billy Bob Thornton.
Yes, I think so. Go back to the animals, Mark. Okay.
I'd say also don't pick a non-core stock after we're just talking about the alignment of growth investing in our core principles.
So my time.
Everybody take those lessons to heart.
All right. Well, this explains why I could never get anybody to dance with me at the high school dances. Good stuff.
I was going to mention, Mark, you might not be surprised, but I did have some numbers for you. I guess it's too late to influence the voting. The U.S. in 2023 had 284.6 million vehicles, and annual sales as of last month were 16.9 million. So if the auto industry was completely transformed from internal combustion engines, it would take 16 years to replace the existing fleet.
Well, that would have
That's quite a runway.
That would have helped me.
Yeah, I was convincing a Tesla bull that's a long way off. They were looking for 20% of miles driven in a year. How far off might that be?
Okay.
Long way.
All right. Well, those 4 people that voted for Devon Energy and we're going to have a Christmas party together, and the rest of you are not invited. Good stuff. All right. Here's your reminder that we do archival purposes. We've placed the recordings of our bull sessions and the roundtables. If you're not familiar with the bull sessions, we go through a multi-week selection process of our best small companies. That's the season for that now. We finalize the selections come October, hence the Red Rabbits. That's our mascot for small companies, and we're having a lot of fun doing that. You're certainly welcome to join us for that. Go ahead, Ken. You want to share some thoughts here?
Well, again, if you're anywhere near the eastern suburbs of Cleveland this coming weekend, join us Saturday morning. The session starts at 9:30, and if you go to the Northeast Ohio website on the Better Investing page, you'll get all the details that you might need, including the address for where we're going to be. We have roundtables coming up. Notice that in our November roundtable, we have occurring on December 2nd, and that has to do a little bit with where Thanksgiving is on the calendar. And then our January roundtable
These are actually
will
wrong,
be,
aren't they?
I don't think those are right. I think that's November and December, Mark, rather than December and January. Okay. So the November roundtable on December 2nd and the December roundtable on January 6th. And again, the holidays are intruding on our dates, so we're going to just move a little bit. We're going to stay at 7 o'clock. That's proven to be very, very good for our attendance. And we're still getting mail, people thanking us for moving it back from 8 o'clock where it was. So if that session on small companies right now is scheduled for November 1st, and if we do have to change that, we'll let you know. But right now, that's a pretty hard date, and we'll try to get our list all ready to go at that particular time. Again, I want to thank Kevin Galogli and Craig Bramer for their participation in our very first campfire session. I thought it was an interesting and informative discussion, and we'd like to solicit ideas about what would you like us to discuss in a panel type setting. And we're going to try to bring you voices from all over the country to add to our dulcet tones another couple times this year yet.
Yeah,
With that,
I just wanted to point out that for the group that joins us in Cleveland on Saturday, I will be the guy wearing the Devon Energy uniform.
Sweatshirt. Okay.
Now, Mark, is it true that after you're done with this presentation, is that there's going to be a tour of all the great haunts of Ken Kavula's home?
Oh yeah, we're going to do his paper route and all that kind of stuff.
The newspaper route he had for the Plain Dealer and everything else.
Absolutely.
I did not work for the Plain Dealer. Okay, I worked for the Cleveland Press. All right.
Oh, well then you better show off the press then.
And the Cleveland Press was very good to me. They gave me a full ride for the first 2 years of my college education. So I'm forever grateful to that long gone newspaper for helping me out when I really needed it. With that all being said, let's say a real big thank you to Cy Lynch. Cy, your loyalty to the roundtable is something that we really appreciate. And Mark, you know that I appreciate everything you do for the Mid-Michigan chapter, as do the folks in the Mid-Michigan chapter. So we just hope you can stick around and keep on doing it for us and helping us out. And with that, is there anything else, anybody besides Kevin that wants to say anything?
I do think there is one good question.
That.
There's one good question to catch up. Marie Frank, I think this is appropriate for any non-core stock that comes in. Marie Frank asks, Mark, what is, since Devon should be approached maybe as a special situation, what's your exit strategy for
it? He doesn't really think about that kind of bad karma, Matt. Okay.
Well, you see,
he
as
knows it's going to make money. All right.
That's one of the things I found interesting about that guy from the 1920s who got to the end of his research, found out that it disagreed with what he was expecting, and he published it anyway. If that were me, I'd just throw it in the waste can and ignore it. So, yeah, just very profound. So, yeah, Marie, if it doesn't work out, it'll probably just mysteriously disappear from the ledger. But that's
the great silence, Marie. Okay. Good night, everybody, and thanks for coming. We appreciate you a lot. Bye-bye.
Good night, all. Thanks.